A wonderful day to you all. Welcome to Nifty Sense. Let's look into the prime reason for the fall of gold and silver before we dwell in to today's market news. Imagine you're in a crowded stadium during a storm. Everyone is rushing toward the exit marked gold and silver, believing it's the only safe place to hide. But just as the crowd reaches the door, the security guard, the U.S. Federal Reserve, locks it and announces, "Actually, the storm is over, and the stadium is now charging triple for entry." That is exactly what happened on January 30th, 2026. Gold and silver, which had been on a parabolic moon mission, didn't just fall. They experienced a gravity discovery moment. Let's strip away the jargon and explain why the world's most trusted metals just had their worst day in decades. 1. The hawk in the Fed, the Kevin Warsh effect. The single biggest grenade thrown into the metals market was President Trump's nomination of Kevin Warsh as the next Fed chair. The analogy: if the economy is a car, a dovish Fed chair keeps the foot on the gas, low interest rates, which makes gold zoom. Kevin Warsh is known as an inflation hawk. He's the guy who slams on the brakes. The logic: markets realized that with Warsh in charge, interest rates might stay high for a long time. Gold and silver pay zero interest. If you can get a 5% or 6% return just by keeping your money in a U.S. bank, bonds, why would you hold a heavy bar of gold that pays nothing? The opportunity cost of holding gold suddenly became too high. The superdollar rebound. Gold and silver are priced in U.S. dollars. They have an inverted relationship. When the dollar gets strong, gold gets weak. The analogy: think of a seesaw. On one side is the U.S. dollar. On the other are commodities: gold, silver, copper. Today, the U.S. dollar put on 50 pounds of muscle because of the Warsh nomination. As the dollar side of the seesaw crashed down to the ground, gold and silver were sent flying into the air. The result? For Indian buyers, the rupee also weakened, but the global crash was so violent, gold down 11%, silver down 30% plus, that it wiped out any currency protection. The margin guillotine, systemic forced selling. This is the technical reason most people miss. When you trade gold or silver on an exchange, like the MCX or CME, you don't pay the full price. You pay a small security deposit called a margin. The hidden narrative: as prices started to dip, the exchanges, CME and MCX, suddenly raised the security deposit requirements by 30 to 36%. The chaos. Imagine you rented an apartment for 10,000 rupees a month, and the landlord suddenly demands a 5 lakh rupees deposit by tomorrow morning or you're evicted. Most traders didn't have the extra cash. They were forced to sell their gold and silver immediately to cover the gap. This created a waterfall effect. Selling lead to lower prices, which triggered more margin calls, which lead to more selling. The silver short squeeze collapse. Silver is the wild child of the metal family. It's much smaller and more volatile than gold. The deep dive. Large banks like JP Morgan reportedly had massive short positions, bets that the price would fall. When silver hit $120 earlier in the week, these banks were losing billions. Some analysts call Friday's crash a system rescue operation. By triggering a massive sell-off and raising margins, the system allowed these big banks to cover their shorts at the bottom, $78, potentially saving the exchange from a systemic collapse. Yesterday, the markets felt like a high-speed train that suddenly slammed its emergency brakes. The Union Budget 2026 hit us with an STT securities transaction tax hike that sent the Sensex plunging 1,500 points in a single session, the worst budget day crash in 6 years. But today, February 2nd, the hidden narrative shifted. While the headlines screamed about the tax pain, the smart money was looking at a different page of the budget: the 53.5 lakh rupees crore infrastructure and data center push. Why did the market suddenly decide to forget the tax hike and rally nearly 1,000 points today? Is this a dead cat bounce, or have we entered a new era where data is more valuable than gold? Let's dive into the pulse of the market recovery. Closing figures, the 2nd of February 2026. After the bloodbath on Sunday's special session, the bulls returned with a vengeance today. Nifty 50 closed at 25,088.40, up 262.95 points, plus 1.06%. BSE Sensex settled at 81,666.46, soaring 943.52 points, plus 1.17%. Rupee. The Indian rupee staged a massive comeback, rising 42 paise to close at 91.51 against the US dollar. Top 10 headlines. The post-budget reality. STT aftershock. Traders are still digesting the hike in STT on futures, up to 0.05%, and options, up to 0.15%, but long-term investors are pivoting to cash delivery. The data goldmine FM announced a long-term tax holiday until 2047 for global cloud providers setting up in India, sending data center stocks to the moon. Oil peace treaty? Crude oil prices crashed 5% after Donald Trump suggested serious talks with Iran, easing India's inflation fears. Greenland dispute. Global markets remain jittery over a trade spat between the US and Europe over Greenland, causing a risk-off sentiment for IT. Bank privatization 2.0. Reports suggest the government may allow foreigners to own up to 49% in state-run banks to infuse fresh capital. Cigarette tax burn. Godfrey Phillips fell 4% as new additional excise duties pushed cigarette prices up by Rupee 22 to 25 per pack. Power Grid's capex surge. The company raised its FY26 spending guidance to 32,000 crore rupees, signaling massive infrastructure expansion. Rare earth corridors. Budget 2026-27 proposed special corridors in Kerala, Odisha, and Tamil Nadu for processing rare earth minerals. Biopharma Shakti. A new 10,000 crore rupees allocation aims to make India a global biomanufacturing hub. Nuclear power extension. Customs duty exemptions for nuclear plant components were extended until 2035. Top 3 gaining sectors. 1. Auto, plus 2.15%, driven by explosive January sales figures from Tata Motors and M&M. 2. Oil and gas, plus 2.04%, rising on the back of falling global crude prices. 3. Realty infrastructure, plus 1.61%, fueled by the 12.2 lakh rupees crore capex target in the budget. Top 3 losing sectors. 1. IT, minus 0.47%, weakened by U.S. tariff fears and the Greenland dispute. 2. Healthcare, minus 0.08%, underperformed despite the biopharma plan as investors booked profits. 3. Specialized manufacturing, select names hit by the higher cost of imported electronics. 4. Institutional flows, the handover. FII net activity, last reported. 588.34 crore rupees. Net sellers, DII net activity, last reported. 682.73 crore rupees. Net sellers. Imagine a school cafeteria. On Sunday, the principal announced that the tax on trading snacks, F&O, just went up. Everyone panicked and tried to sell their snacks at once. Today, the students realized the cafeteria is getting a massive upgrade with new vending machines and better food, infrastructure and data centers. The panic sellers are gone, and the bargain hunters are buying back the snacks at a discount. Market breakdown. The cloud and the crude. The market moved today due to professional cause and effect logic. Effect 1. The rupee's recovery. When crude oil prices fall, India, a massive importer, saves money. Think of it as your family's monthly petrol bill suddenly dropping by 10%. You now have more money to spend on other things. Effect 2. The data center pivot. By providing a tax holiday until 2047, the government isn't just inviting companies, they are building a digital fortress. This is a structural shift, moving away from just providing IT services to actually hosting the world's data. Green Flag Deep Dive. 2 stocks with institutional footprints. 1. Power Grid Corporation. Value Moat Power Grid is the highways of electricity. You can generate power anywhere, but you need their wires to move it. They just hiked their CapEx, capital expenditure guidance, which is a signal that the government is ordering them to build more roads for the nation's energy. Institutional data. The stock surged nearly 8% today. This is relative strength at its finest. When a utility stock moves like a tech stock, it means the big fish are buying the reliability of the grid. 2. Anant Raj Industries. Value Moat. This is no longer just a real estate company. It's a data infrastructure play. With the budget's tax break for cloud providers, Anant Raj's massive data center portfolio has become prime digital real estate. Order book. Management commentary suggests a massive surge in demand from global AI firms looking to host servers in India. The conclusion, is the bull run dead? In professional terms, we have moved from an overbought zone to a value reset. The lesson, never confuse a safe haven with a risk-free asset. When everyone is on the same side of the boat capsizes. Gold and silver are currently in a structural re-rating phase. While the long-term story of de-dollarization remains, the short-term reality is that the US dollar is still the king of the playground. Wealth preservation thought. True wealth isn't made by catching the peak. It's made by surviving the crash. If you bought at the top, you're feeling the burn. If you were waiting on the sidelines, the accumulation zone is finally starting to appear.